Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Technical analysis, I would argue, is really based on the fundamentals of behavioral finance, what happens between our ears, how we're hardwired to make poor decisions, and how we can use a practical set of tools called technical analysis to arguably remove or minimize the impact of some of those behavioral biases and focus on the evidence of the markets around us. Sort of an open, high, close, low feel to the tape today, although it wasn't a big loss of ground or anything like that. Sort of a choppy midweek period as we think about the seasonality. Tends to be pretty strong here in November and December. We have a great guest today, Jeff Hirsch of the Stock Traders Almanac. We'll talk about his upcoming 2024 Stock Traders Almanac, the seasonal tendencies we tend to have in November, December, what the election year next year might hold for all of us. One other comment, Charlie Munger just found out that he passed away, 99 years old, longtime collaborator and co-worker of Warren Buffett. So many people that I know learned so much from going to the annual meetings at Berkshire Hathaway, listening to the wit and wisdom of Charlie Munger. One of the things I would say, if you want to celebrate a legendary investor and what he contributed to the thinking of the investing community, read a book, read many books. He was a voracious reader, not just about investing, not just about the markets, but about anything and everything. Be a sponge and learn from those that came before us. So rest in peace, Charlie Munger. Let's get to the market recap and focus on how the markets evolved through the course of the day today. Before we get there, let's answer a quick poll. We asked you recently on our social media platforms, is your allocation to equities higher or lower than 6 months ago? And I actually gave you option 3, about the same. Interesting to me to see an increase in allocation, right? Most people, almost most, right? 45% said they'd increased their allocation to equities since 6 months ago. If you go back 6 months, that's going to, right, sort of May, June type of period, which is as we are sort of really pushing through to the upside, getting toward the previous highs that ended up being in the summer, July, August. Now all of a sudden seeing another rebound. The name exposure index kind of mirroring what we see here with the poll of our final bar viewers, sort of increasing their allocation to equities. Name exposure index last week on the Thanksgiving shortened week was up over 75%. I think it was about 77, 78%. So you're in good company increasing your allocation. Some would argue there's plenty of upside to be had for stocks, so you need to be there to participate in the upside. Thanks for answering that poll, by the way, and don't forget to subscribe to our YouTube channel. Follow us on all the socials. You won't miss the next poll question. Let's get to our market recap. As I mentioned, sort of a choppy day, opening higher, closing lower. The S&P opened up sort of in the 45.80, 45.85 range, ended the day down around 45.50. That's just a slight loss from yesterday on a closing basis, just down 0.1%. The NASDAQ composite down 0.2%. The Dow Jones Industrial Average essentially flat from yesterday's close. You can see mega caps down while small caps up. Again, not a huge move on either side, but sort of changing the characteristic or the contour of the market that we've experienced in most of 2023 with mega caps working and sort of everything else in a lot of ways playing catch up. What's interesting is if you look at the small cap index, biggest sectors are things like financials, where you're seeing actually a nice rebound. A lot of the regional banks are actually showing some renewed signs of strength. We'll look at some of those charts if we have time in our market recap here. The VIX actually moving slightly higher, but still right around 13, and that's very low relative to the range we've been in for the last 12 months or so. We're back down in that low volatility environment that we experienced through most of 2021, which is one of those slow and steady uptrends, minimal drawdowns, low volatility. It's kind of what the market is feeling like right about now. Looking at the bond markets, you'll see the red across the shape of the yield curve. Bond prices actually moved higher. Today, the TLT was up about 1.25%. And if you think about what has allowed our growth-oriented benchmarks to push to the upside as they have, with the S&P testing 4,600 resistance, the QQQ, breaking above resistance from the summer, it's the fact that interest rates have come down so much, right? The 10-year yield not too long ago was up around 5%, now down below 4.3%. Same can be said for the 5-year yield. And the long bond yield, which was above 5% earlier this year, down to around 4.5. We'll call it 4.45. So you're seeing rates come down. You're seeing bond prices improve. And that reduction in rates is certainly helping growth stocks to sort of re-exert their upside. Looking at the commodity space, you can see the DBC up about 0.7%, gold up slightly from yesterday's close, silver down slightly, copper prices down as well. Crude oil moving higher. The energy sector not having a particularly strong day, but doing okay. Finally, cryptocurrencies, a lot of red here. You can see Bitcoin down about 1/3%, Ethereum down 1%, and sort of mixed bag the rest of them. Now, Bitcoin really sort of hanging around that 37, to 38,000 region, coming down about 1/3% today, but overall, still in a position of strength. We'll talk about the momentum here in a minute as we get to the daily chart of the S&P 500. Before we do that, just to let you know about the sectors, real estate number 1, financials number 2, followed by materials. On the downside, we have consumer staples, utilities, energy, all down about 0.8% from yesterday's close. Let's go to a daily chart of the S&P 500, sort of look at this 4,600 level. You can see the high from July. You can see we're retesting that high here at the end of November. 4,600 is this green shaded area. I tend to think of support and resistance not as firm levels. I don't think it's an exact science. I think it's more of a range. And so the fact that we've rallied up to retest those highs, I think is pretty important. Now I think we're sort of in that range where we're testing that previous resistance level. And the question is, will we power above it or hold steady there? Interesting is if you look at the relative strength index, the RSI at the bottom of the chart, you can see the peak in June, you can see the peak in July, you can see the peak in November. Every one of those times, pullback at least a little bit, right? The June pullback, sort of a minor pullback back in July, August, more of a significant drop that really continued through the course of September and October. Now we have a similar sort of configuration where the price has rallied. We're seeing the RSI overbought, right, with the RSI just above 70. And what that usually means are two things. Number one, the fact that the momentum is so strong is actually pretty encouraging. That means the conditions are actually pretty positive. The fact that the RSI even gets to that overbought region is usually pretty encouraging. And then you'd expect at least some sort of pullback, and that's what we saw in June. That's what we saw again in July. And I would argue that's what we may see here in November. So let's continue on here, and apologize. I'm just getting over a cold here after the Thanksgiving holiday. I appreciate you guys being patient as we sort of navigate all of this. Let's talk about a couple different breadth indicators. One of the breadth indicators I'd like to highlight is the McClellan Oscillator. As you guys know from watching the show, the McClellan Oscillator, good measure of breadth conditions, measuring stocks moving higher or lower. It's based on advanced decline data. It is sort of a short-term indicator. So you don't really want to think about a chart like this as a long-term gauge, right? The fact that the McClellan Oscillator is above or below zero doesn't tell you about the next couple months or the next couple years or anything like that. It's really only telling you about the particular conditions right about now. And if you look, we broke above the zero line there at the end of October. From there, we've continued with the McClellan Oscillator above zero. Obviously, the price has moved higher just fine. If you look at those previous green shaded areas, that's been when the market has actually done quite well. What you're looking for in this particular environment is when the oscillator goes from above zero to below zero, right? That's the danger sign that we saw back there in the end of July of this year, mid-June. We saw it in April. We saw it in February as well. And each one of those times, again, not necessarily the end of the world. For example, in April and May, it was a 6-week more consolidation phase before a resumption of the uptrend. But overall, you're looking to, looking for a drop below the zero level is a sign that maybe things are starting to get a little bit worse. For now, we're seeing the McClellan Oscillator remain above zero, and that's actually a pretty bullish configuration. Now, one other indicator I want to look at is this one. This is the percent of stocks above their 200-day moving average, percent of stocks above their 50-day moving average. Now, the 50 days, this is the one that I want to look at. If you look, it's currently around 77% as of today's close. What I'm highlighting here with this pink area is when this indicator has gotten above 85% or so, that would get us into this pink shaded area. The last 3 times that the percent of stocks above their 50-day has become this extreme was in July, which ended up being, for now, the high in 2023. End of November of this year, which is when we were testing the 200-day moving average. And then previous to that, in August of last year, that is, as we were testing the 200-day moving average as well. Now, each one of those times, the conditions were actually quite bullish, right? The breadth was positive as we were rallying. We'd had an incredible run to the upside. A lot of stocks, if not most stocks, were pushing higher. As a result, this indicator got up to above 85, 90%. That was usually the sign that it was at the end of that move, right? And again, to be clear, what I don't like to do is think, all right, when it hits 85%, that's your sign to sell, right? It's an automated sort of, a specific indicator. For me, it's more of a sign of the times, more recognizing the strength that we've seen and helping me or encouraging me to look for signs of a reversal. And in every one of those times, after that indicator became, above the 90% or 85% level, soon after that, you saw a rollover in stocks. And that's the signal I think you want to be patient for. So as we're running higher, as we're testing 4,600, as the RSI is becoming overbought, you can see this indicator getting near to the point it's been at the end of previous upswings. And I wouldn't be surprised if we get at least a bit of a drawdown after that extreme move to the upside. I do want to highlight a couple things here to finish off our market recap. We're going to look at gold here momentarily, and then we're going to look at some individual stocks. I'm going to talk a little bit about the banking stocks, because as I was scanning for stocks making new 3-month highs, which is an exercise I do for my market misbehavior premium members, I happened to notice a lot in the banking sector. Regional banks like Key and Huntington banks and others, many of them actually testing and breaking above the 200-day moving average, which I think is pretty important because it's been quite some time since they've been able to do so. Start with the chart of gold, though, here, and this is the GDX. So we have a couple different ways we can look at gold. You can look at the GLD, which is an ETF that tracks spot gold or physical gold. We have the GDX and the GDXJ, which track gold mining stocks. The GDXJ are sort of the smaller, more speculative versions of that indicator. Or we could look at individual names, right, like RGLD and Newmont Mining and Agnico and other mining stocks that we could track. The GDX, I think, tells this story quite well, right? If you look at the $30 level, which is where I'm highlighting here with the cursor, if you look, you can see the sell-off from the April and May peaks down to the low that we established in early October. If you look at the low in October, to the left, we have the higher low in August. To the right, we have the higher low in November. Between those 2 points, we have the resistance level, or what we call the neckline, right around 30. And if you look, this level coincides pretty well with the 200-day moving average. We've been talking about this level and looking for sort of a follow-through on what's called an inverted head and shoulders pattern. Now, an inverted head and shoulders pattern is basically where you have a low surrounded by 2 higher lows. The neckline is vital because until you break above that neckline, it's really not a completed pattern. Just this week, we're actually seeing the GDX break above that resistance level, which tells me actually to expect much further upside for gold. And what's interesting is, if you look at the last 6 to 8 weeks, we've seen weaker oil prices, weaker dollar, and stronger gold. So the fact that the GLD and GDX are actually breaking out makes sense given the trajectory we've seen recently. And again, I think, excuse me, getting above the 200-day moving average is what's so impressive here. Let's look at some of the banking stops. We can look at a couple different things, but I'll start with the KRE because I think a lot of the regional banks have a similar configuration to what you might see here. Now, what marks the chart, one of the things, I forget which guest it was recently, we were talking about taking the price away and just looking at the moving averages. Thinking about the trend in the moving averages and the slope of the moving averages is telling you a little bit about the characteristics of the underlying stock. If you look at just the simple slope of the 200-day moving average for the KRE, the regional banking ETF, I think it tells you a lot about just what the story has been or what your experience has been owning regional banks in 2022 to 2023, and it's not been good. Now, on a price basis, the big sell-off happened in the first quarter. February, March, April, May, all kind of undercutting previous lows and making new lows. If you look, the downward slope of the 200-day sort of gets rid of that noise and just focuses on the direction of the trend. Now, what's happened here in the last couple months is you've actually put in a higher low at the end of October. And if you look here, the higher low at the end of October, higher low in early November, now once again a higher low as we broke above the 200-day moving average, and now pushing to the upside. And what's interesting about that chart is if you look at KeyBank, or if you look at Huntington banks, or any other number of regional banks I could bring up, they all kind of have that similar configuration. A 200-day moving average that's been sloping downwards. We're just finally getting back above that 200-day moving average today or this week. Now, I think the bull case for financials is questionable because it's all based on these trends that have been working to continue to work. So the most bullish thing the market can do is go up. But as Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. I think we're seeing further upside here with Huntington Banks, with KeyBank and others breaking above the 200-day. The question is, can they hold that 200-day moving average and even push further to the upside? Next chart I want to show you is Alphabet. Now, we can look at a lot of different mega cap stocks. We talked about the mega cap dominance in 2023. I think Alphabet is a good place to start here. Now, the story of the markets here in November of 2023 as we go into December, and again, as we'll hear from my guests here, November and December tend to be quite strong. We're in that seasonally stronger part of the year. What's interesting about Alphabet and Apple and Microsoft, a little different because it's already broken out, but with a lot of these names, AMD is another good one that comes to mind. We're for now making a new high, a swing high, but it's below the previous high in September and October. Apple, Alphabet, AMD have yet to power to a new swing high. And I would say, if you're looking at the QQQ and the S&P 500 and you're thinking, what are the chances that the S&P pushes above 4,600 and sees further upside? I would argue that's going to happen if and only if the Alphabets of the world are able to power higher. Alphabet above 140 makes a new high for the year. Also, most likely would mean the RSI gets above 60, which would mean it goes from more of the bearish range that we've seen for Alphabet to more of a bullish range, with the RSI pushing above that 60 level. So I think with some of these charts, there's still a little bit less left to be proven to see if they can push on to the upside. Last chart I'm going to show you here is WestRock Company, which is a material stock. You may be less familiar with this one. This is a containers and packaging name in the material sector. And if you look at WestRock, the reason why I wanted to highlight this name is a couple things. Number one, I think it's a beautiful rotation, or a beautiful chart demonstrating the rotation from a distribution phase to an accumulation phase. A distribution phase, in my way of describing it, is when you have a chart making lower lows and lower highs, where the moving averages are sloping downwards, where the momentum is more in the bearish range, with the RSI tending to remain below 60, and overall suggests that there is a distribution at play. And that trend usually continues until proven otherwise. And I think in March, then May, then June, you saw the chart go from making lower lows to actually making stable lows. Then we saw the big change. Look what happened here when WestRock broke to a new swing high, a new 3-month high here in July. Then gets above the 200-day moving average. Then instead of failing at the 200-day like it did in January, it actually broke above it, pulled back and tested that level from above, and then moved to the upside. Now we've had a couple pullbacks to an ascending 50-day moving average. The momentum is now firmly in the bullish range. So charts like this that have been in a distribution phase, now in more of an accumulation phase, I would argue pretty attractive here. Now just today, you're seeing WRK WestRock go up about 4.4%. So, it's had a nice run here in the short term, but overall, a chart like this tends to persist. And I would argue trends in motions tend to stay in motion. So a WestRock moving up by 4% as a continuation of this uptrend is what, for me, is most encouraging more than anything else. That's it for our market recap. I want to wrap things up and bring on my guest today, Jeff Hirsch, here in a moment. Before we do so, though, a couple quick announcements. First off, we would love to hear from you. Our mailbag is always open. You can email us your questions at thefinalbar@stockcharts.com. We are on the Twitter @FinalBarSCTV, and on our YouTube channel, of course. Just drop a comment in our live chat. Drop a comment in the comments section below the video. We'd love to hear from you. We hope to do a mailbag segment maybe at the end of this week, and we'd love to feature one of your questions live on the air. Also, to let you know, our 2024 Stock Traders Almanac sale has now started. If you go to the Stock Charts store, I'm actually showing it on my screen here. Excuse me, store.stockcharts.com. Search for the Stock Traders Almanac. You actually see a message right at the top of your screen as well. We are offering Jeff Hirsch's fantastic annual offering, thinking about seasonality, market history, and really learning the lessons of investors that have come before us, some legendary investors like Charlie Munger and others who are quoted every day in the Almanac, which I always love looking forward to. I have gotten this book every year that I can remember as an investor. When I first started, someone shared it with me and asked what they were looking at, and I've learned that having this on my desk as part of my weekly exercise of preparing for the week to come and thinking about some of the seasonality along with other things like economic indicators and earnings, super vital. So I'd encourage you to check it out. This is the time to do it, and I'd love if you'd do it from the Stock Chart store, of course. With that in mind, as a great intro to our guest today, I want to bring on Jeff Hirsch. Jeff is the editor of the Stock Traders Almanac. CEO of Hirsch Holdings, coming to us from the New York area. Jeff, good to see you. How have you been? Okay.
I'm great. How you doing? What's with that cough?
I know. The bad news about traveling so much, I feel like I picked up some
Yeah,
germ baggage on the way, but we'll get through it. I feel like.
I got
You know,
something to the airport a little while ago myself.
it happens. It happens. But I'm glad we're able to travel, so I'm thankful for that for sure. So Jeff, I was totally honest when I gave that introduction, talked about the Stock
hmm
Traders Almanac. I've been reading it for years, and I have it on my desk every day when I'm looking at the markets. When you're looking at these markets right here, it just strikes me. We had you on the show over a year ago. I think it was September of last year, August last year, and you kind of laid out this midterm election to pre-election year. Here's what it's going to look like. I can't imagine it could have followed much better from what you described. How has that experience been like, sort of following the market with this seasonality that I feel like was scripted ahead of time?
It's a little scripted right now. It's making me a little nervous, admittedly, when everything fires so perfectly with the 4-year cycle and the seasonalities. It's been tracking very closely since 2021. I mean, this chart here that it comes out of the 24 Almanac with the updated cycle for where we are right now. It's just uncanny. And I think of some of those quotes that are in the Almanac that I know you love and use, and I appreciate how you use it like it's meant to be used. Guys like John Malone quoting Moses Shapiro that few people have plans when their assumptions are wrong. You always got to ask the question. If not, that's Talmudic wisdom, he says. And then Edson Gould, if stocks don't rally during their bullish season, there are other forces that are stronger. And when that season ends, those forces will really have their say. So people ask me, I'm already bullish. My outlook in the book is bullish for next year with the sitting president running for re-election, which we can look at that in a second too. But I'm asked, what's going to derail your outlook? And it's right here in the seasonal work. I mean, I look at fundamentals and technicals, and I'm with you on the behavioral finance aspect of it. But seasonality is our foundation, cycles, patterns, and trends. But when it's not working, when something that's really got a great record of working doesn't happen, it's an indication that something's going wrong. So right now, it's uncanny with the October low, the seasonal rally that you are highlighting there, the sweet spot of the 4-year cycle delivered. Yeah, we had a little bit of a sell-off in December last year with NASDAQ mostly. But that was, sort of kept people honest. I think that not being so, here, everyone's talking about seasonality now, which scares me. I love the props. I love the fact that people are giving it cred, but, I'm a contrarian at heart. So if everyone's talking about it, then it concerns me. So it's set up very well. It's not going to always work this way. Nothing works 100% of the time. You don't work 100% of the time. You were on vacation. You went to see people. I don't work 100% of the time. So we're still tracking closely. This calls for a potential of encroaching on new highs or getting back up to higher levels at the end of the year. Just watch out for early December. It tends to be flat with tax loss selling and portfolio restructuring. I hope when that does happen, if it does, that people get all worried, because that'll reload the bears and the contrarians. And then I also expect some sideways action in the middle of next year. But in the book, there's this year's edition, there's a whole bunch of stuff on the election year. And the first 5 months are important. And there's some talk in the news about some of Wall Street people not wanting Biden to run. He's too old, whatever the case may be. They're not looking at this chart that you just pulled up, the power of a sitting president running for re-election. When you've got the guy or a person who's in office running again, S&P's up 12.8%. When it's an open field, the red line there, it's minus 1.5%. So, as a bull or, with my forecast, I'm hoping for the market to go higher. But if something should happen, and you'll see the market, you kind of can handicap it, sort of reverse engineer it. When the president, wins, first 5 months are up, and the last 7 months are always strong. But if the first 5 months are down, that might mean that there's a problem with the incumbent or the incumbent party, which might also lead you to think that the market might be a little more trouble. So I reserve the right to adjust my forecast as needed. We'll look at our January indicator trifecta, which is a feature page this year, standing on top of Yale's shoulders. You know, it would have been his 100th birthday last month, or October 23rd. I put out some things on there, and you know, it's interesting, you know, that we stand on his shoulders with the January barometer that he invented. As January goes, so goes the years. Santa Claus rally, which everyone gets wrong. You and I have that discussion. You know, people are out there talking about this. Santa Claus is going to have a Santa Claus rally. It's all happening already. It's an indicator. Last 5 days of the year, first to the new year. We combine those together with the first 5 days of the year, an old indicator from, you know, before the 40s or whatever. And what happens is that when we hit those three, like we did this year in 23, not unlike what we did, it didn't happen in 22, which is another indicator. Market's up 90% of the time, 28 to 31 years, 17.5% on the S&P. So we'll be looking at all those things as we get into this really most important seasonal period of the year. In addition to our other disciplines, fundamentals, economics, with GDP was pretty nice today, the update. You know, there's 5.2%. I think some of the technicals that you pointed out are very important. As you know, I track that. There's a level in there that I was watching, you know, where we bounced off of, that 4,100 S&P level, which, if you want to pull it up, it reminds me, it reminded me of the level that I had on a chart. Now, I look at events. Now, you're not going back far enough here, but if you go back to February 22, when Russia invaded Ukraine, that was the intraday low on the Dow, on the S&P. And that's
right around here.
And we bounced off that. It was a little bit higher, like 41.14 or something like that.
Yep.
And it's uncanny how we rebounded off that again. So that's another bullish, you know, feather in our cap. So I'm looking for 8 to 12%, maybe more, for S&P and NASDAQ in 2024. If we get a cut, it could add some juice to it. I'm not expecting a cut. I'm not expecting a recession. People have been talking about it for way too long. I'm over it. It didn't happen. I think we had a recession in 22 with the first 2 quarters, you know, down consecutive GDP numbers. So, you know, we're just riding the wave here, but asking the questions. If not, got our stops in place. We found some interesting stocks also as well. I mean, I'm trying to cover for you here, but just continuing to.
No, you're good, Jeff. Tell me this. So with small caps, one of the things we were talking about before we went live was how small caps really hadn't participated. Now we're seeing a bit of a bounce. Give your take on what that means for small caps to be a part of this story. Where does the seasonality fit in for the small cap space?
There's a couple of things there. Number one, yes, they've been underperforming. You got Fed hiking rates. You know, at the beginnings of bull markets, when the large caps take over, small caps have trouble. You see the spike back in 2020 when, you know, small caps rally a little bit, but there's some struggles there. There's some fundamental factors. But the seasonal aspect, which is what I look at, aside from the overall picture, what we specialize in is that the January effect of small caps outperforming large caps has really moved to the end of September effect, and end of December. Sorry, I misspoke. And we see this comparison that we do in the Almanac of the Russell 1000 over the Russell 2000, and you can see we split the year differently. We started in July, so the middle of the year, the September October low. In the ratio of the 2000 to the 1000 starts to bottom around late October into November, and then takes off after mid-December. I keep screwing those up today. So that's what I'm looking for there. But again, with the mantra of, you know, things that are supposed to work aren't working, you know, small caps don't rally, at least the last 2 weeks of December. There's something underlying there that's troubling. And then we'll be looking to Santa Claus rally and the January barometer and stuff to see if the market is really behaving as pictured perfectly with the cycles and the patterns, seasonal patterns, as it looks right now.
Tell me this, Jeff. So when I use this Stock Traders Almanac, sort of lays out, you know, what the election year might look like, right, based on the historical tendencies. And I think your second chart was brilliant about thinking about, you know, whether Biden runs again, what that might mean. But when you have this sense, I mean, election years tend to be pretty strong, right? It certainly tends to start pretty well. What would tell you that?
7.3%.
Yeah, what would tell you that we're diverting from that, or what would it mean if all of a sudden we start opening low in January? Is there a level or a signal or something that would tell you, okay, this is now something totally different. I need to get more defensive. Is there a level or a signal or a pattern that would tell you all of a sudden things are a lot less optimistic than I seen? How would you think of it that way, I guess?
I mean, my initial, my initial reaction or indication would be the Santa Claus rally. If Santa Claus had failed to call, bears may come to broad wall. Then the first 5 days, and then the full month January barometer. So once we get to the end of January, I'll have a good idea of whether the usual bullish implications of an election year and the seasonal period are in place. Then there's going to be some technical things we'll look at. You've been talking about the 10-year yield. That 4.3 level has been something that we earmarked for a while. It put the hurt on the market when it went above that over the summer, and now that we're back below what you highlighted that in your update earlier, those will be things we're looking at. If the Fed gets spooked and starts cutting like crazy, that's going to scare people that something bad is happening. I'm not so sure they're quick to cut. The market and the economy has digested it pretty well. These rates are historically average. Yes, it was a big move up from the bottom. It's a different world. There's a lot more productivity out there than the old days. I don't subscribe to that inverted yield curve indicator. It's not as great as everyone cracks it up to be. So there'll be some technical levels. I highlighted the 4,100. That's going to stick in my head on the S&P just because it was something that jumped out at us. Yeah. It was resistance for a while back in 2002, and then it became support recently. So there's a number of different things. Bullish sentiment, I'm a contrary sentiment guy as well. Right now, investors' intelligence is pretty bullish. It jumped up a lot. So we're probably looking at some short-term pause there. But and these factors can change. You look at different things as they become more relevant. So again, seasonal indicators, technical levels, economic readings, and something that we might not be expecting right now.
Jeff, you laid out so much for us. I really appreciate you doing so. And thanks again for all you guys are doing with the Stock Traders Almanac. It really is something I've come to rely on, and I hope others take advantage of that for next year as well. Be well and stay safe. Have a great holiday season. We'll talk to you in the new year, okay?
Appreciate it, Dave. Thanks.
That's Jeff Hirsch. Jeff's the CEO of Hirsch Holdings, the editor of the Stock Traders Almanac. Jeff's father, Yale Hirsch, really did some foundational work. A lot of the things you may think you know about seasonality probably came from studies of Yale and others promoting that sort of seasonal tendencies. The 2024 Stock Traders Almanac, as I mentioned, now on sale, will be delivered sort of early mid-December. Things like the January indicator trifecta that Jeff talked about, a deep election year breakdown, really thinking about the seasonal tendencies, and things like the best 6 months strategy, which I've really followed and enjoyed following, that Jeff and his team have put out. Really, really worth doing. So make sure you go to the Stock Chart store. Use the code Almanac30, by the way, to make sure you lock in a great rate for the 2024 Stock Traders Almanac. Thanks so much to Jeff Hirsch joining us from the New York area. We've got to wrap this show, folks. Go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Offense over defense. There's so many different ways we can try to measure strength versus weakness in the market, measure offense versus defense. I love looking at things like positioning data and survey data, things that might help me understand how investors are rotating from risk on to risk off. If you look at consumer discretionary versus consumer staples, still neutral. I would argue for the last 4 or 5 months, we've really been sideways. These two sectors have actually moved pretty much in parallel on a cap-weighted and on an equal-weighted basis, but really close to breaking out. And as I think about the S&P testing 4,600, think about the seasonal strength in December and potentially the beginning of next year, I'm very keen to see if these ratios break to the upside, which I would argue would be one of the many indicators which could confirm a new bull leg for risk assets and for the equity indexes. Chart number 2, the Ag Bond ETF, AGG. Now, there are a couple different broad bond market ETFs we like to look at. The TLT, which is Treasury bonds. LQD is an ETF that tracks corporate bonds. And Ag tracks basically the old Lehman Ag Index, Barclays Ag, and I forget what it's called now, the Bloomberg Barclays something Ag. But it's basically the big benchmark that fixed income investors will use to track the performance of the bond markets. And if you look, the ag has had an incredible run from mid-October to late November. This is coinciding with interest rates coming down, right? The 10-year yield coming from 5% down to 4.4%, wherever we're at. What's lining up with that is this rally in bond prices. What's so interesting to me is this great bullish divergence that we observed. And I remember discussing on the show here, lower lows in October, higher lows in the momentum over that same period, very reminiscent of September and October of 2022, which was a bottoming in bond prices for quite some time. So we certainly saw the rally off of the October lows. Now we're getting up to that overbought region, and we're also approaching the highs from the first half of 2023. So very interested to see how the ag can execute a move above that resistance, what that might mean for rates, or if we stall out here as we reach overbought conditions. Finally, the GBTC, the Grayscale Bitcoin Trust. I meant to ask Jeff, we ran out of time for it, but we had Adrian Zadunchik on the show a couple of weeks ago. He did a fantastic job laying out some really interesting seasonal work that Jeff had put together with Adrian's guidance about seasonality with Bitcoin. First seasonal study I've seen on the crypto space, and it's been absolutely brilliant. Talked about strength here in the fourth quarter, and it's been absolutely that. When a chart is going higher, like you're seeing with GBTC, I tend to do a couple different things. Number one, follow that trend as long as possible. And I would always argue, never confuse the top of the page with resistance. Things that have had good runs can often continue to have good runs even further. But I'm also looking for signs of a potential reversal. One of the things that I'm seeing on the chart of the GBTC is a bearish divergence with the RSI. So higher highs October into November, lower peaks in momentum. Looks kind of similar to June, July, before we had a bit of a pause in the uptrend before a resumption of the uptrend. Wouldn't be surprised if we get that sort of pattern. But again, price is king. Follow price primarily, and you will, in general, be on the right side of things. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. Thanks for being patient with your host today, getting through a cough, and special thanks to Jeff Hirsch joining us from New York. Don't forget to like this video, subscribe to our YouTube channel while you're here, and we'll look forward to seeing you the next time. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.